Hello, hello, everyone. Welcome, welcome, and welcome. We thank you so much for joining us today. I want to thank, of course, our Eka, please pardon my friend in the background. She's 4 and she wants to get an early start on learning about taxes. So she's joining us too. Um, but first and foremost, I want to thank the Economic Development Committee of our chapter for facilitating this webinar series, the Financial Fortitude webinar series that they have put together, specifically our chair, Tevlin Thompson, who is just thebomb.com, and she has been making sure that this information gets out and that our community is prepared on all financial fronts. And so we thank you for that. So we thank you for joining us and going on this journey with us to all become more financially fit in all ways possible. And we thank our 2 presenters who are joining us today, Joy Sistrunk and Kevin Moore, who will be presenting. And Tevlin will provide you more information about who each one of them are. But again, we just thank you and we hope you enjoy. Tevlin.
Thank you so much. And once again, I am Tevlin Thompson. I am the chair for the Potomal Valley Alumnae chapter. And we will go ahead and get started. I would like to introduce you the 2 speakers that we do have. We do have Joy Sistrunk, who is a certified public accountant. Joy is the principal founder of the Premier Group Services. And she is a certified public accountant and management consulting firm, where she has a management consulting firm. And Joy is dedicated to, was dedicated at a very early age, where she wished to become a public certified accountant. And so she has her degree in accounting, as well as a master's degree in international business. And she has more than 20 years of accounting experience and has earned a reputation for offering a practical approach for her clients' audit, tax, accounting needs in today's relevant environment. She has in-depth knowledge of operational audits, accounting best practices, compliance requirements, and business tax needs. In 2005, Joy founded the Premier Group Services with over 20 highly skilled staff members globally. The clients prides itself on being able to provide its clients with services such as budget assistance, financial management, financial audits, and tax preparation. Joy's passion for serving others include time served in the United States Air Force Reserve, and translates this to the principles for her company. So thank you, Joy, for attending today. And we also have Kevin Moore, who's also going to be our speaker. Kevin Moore is the co-founder of Richardson and Moore, LLC. It's a full-service accounting firm in Washington, D.C. He established Richardson and Moore in 2003 and brings a wealth of knowledge in accounting, business and financial operations to his clients. With over 20 years experience, Kevin specialized in individual partnership and corporate tax preparation. In addition to his financial experience in business, he is consultant for many business, from startups to mid-level enterprises. Kevin received his MBA with a concentration in accounting, and he has financial knowledge excelled, and that led him to entrepreneurship by opening his own accounting firm and other business ventures that he has managed ever since. So before the presenters get started, we would like to have a couple of poll questions. So that way it will help us to learn who we are serving in our area. And also too, we want to know the knowledge base that we have regarding this topic, and what was going to be presented today. So can we have our first poll question, please?
While they're pulling up those polls, just so everyone knows, this is anonymous, so we won't know who answered what, just so you are aware.
So we do have our first poll questions. So probably give it, I see some more coming through. I'll give it maybe about another second, and then we can end the poll. It looks pretty much for the knowledge-based question, we could go ahead and end the poll. What is your current knowledge of individual taxes? The majority says moderate, but next to that is some. We only have maybe about 4% that said expert. It was 56% that said moderate, and 36% that said some, and only 4% that says 4% that says none. So the majority has at least some moderate knowledge with individual taxes. And what is your current knowledge on business taxes? The majority says none. They have no knowledge of business taxes, and that's 48% that said none. And we had 40% that says some, 8% that said moderate, and 4% that says expert.
Just give me one more minute. I'm just going to capture the results, and then I will launch the second poll.
Okay, I'm sorry, I couldn't hear you, Deborah.
I'm going to capture the results for this poll, and then I will launch the second poll.
Okay, thank you.
Okay, I will be launching the second poll.
Okay, thank you. Deborah, do you need to clear? Okay, I see it now. Thank you. So we give everyone with about 30 seconds or so. And we just like to see, how many people this information would not be shared. Like Brooke said earlier, we would not share this information. It's just only for us to know what type of audience that we are reaching. And also for us to know what we need to do differently, in the future.
Stop the poll. It's a little over a minute. Do you want me to stop the poll?
Yes, please. You could stop the poll. Thank you, Deborah. Okay, it looks like 100% on this call are females. But we do have one male that's a speaker. So, but the participants are all females. The participants are all African Americans, Black African Americans. And the majority of the people have a master's degree. 52% have their master's degree. We have 33% on doctorate's degree, bachelor's degree. And then we have 15% with doctorate's degree. So we have a good variety on the call. So you could, Deborah, do you mind capturing the results, and then you could
Yep,
clear
I'm
out the
capturing
poll?
them. Yeah, I'm capturing them right now.
Okay, thank you.
I've captured the results.
Okay, thank you so much. So if you could clear the poll, or do I need to do it from my end? Could you?
Still see it?
Okay, I had to do it from my end. Thank you. Okay, well, we'll go ahead and get started with the presentation. Unfortunately, one of our speakers is having a little technical difficulty, so he would we would not see his face on the screen, but we will hear from both of our speakers. And so welcome again on George Sistruck and Kevin Moore. So we'll let you go ahead and get started. Thank you. And also to apologize, we will, if you have any questions, feel free to put your questions, in the chat. We will be monitoring the chat, and we will be, answering questions throughout. Thank you. You could go ahead and get started.
Okay. How are you ladies doing this evening? And again, thank you guys for having me and Ms. Joy come and speak to you guys. I apologize for my challenges with technology. I'm a pencil and paper and calculator type guy only. So without further ado, what we want to do is, at least on my end, would like to give you some key changes for 2021 tax years that I think with this very knowledgeable, well-rounded group of young ladies here, I think we'll be able to get through this relatively with ease. But the first slide we have is our recent changes to our 2021 standard deduction line items. As you see, very self-explanatory. They increased a little bit, but these numbers are very important here, depending on your filing status, in terms of when you get to what can be deducted in terms of itemizations versus standard deduction. So if your standard deduction is greater than itemizations, then we have to go the route of the standard deduction because will give us the better benefit down the road. And then on the next slide, what we have is the 2021. Can you guys hear me?
Stop.
Am I moving too fast?
We can't, I think we have a little bit challenges with the slide. So just give us 1 second so the slides could catch up on what you're saying. I do apologize.
Not a problem. I should be on slide 2 or on the way to slide 3. Taxable
yes, you're on
income
slide 2,
bracket.
2021 standard deduction.
Okay. Oh, I can let that. So these numbers are very important. So that way, every year they seem to change a little bit. But these come into play when we get ready to itemize in terms of what are Schedule A deductions, and we'll visit those later on in the presentation. But this is a rough look at the new numbers for 2021. Okay, so if we move to the next slide.
We're there.
Okay, so we have our new tax tables for 2021 with regards to increase in inflation as well. So based on your filing status, you'll drop into one of these particular brackets in terms of your modified adjusted gross income. So if your income is $10,000 or less after, standard deductions or itemization, you'll be in a 10% tax rate, which is considered your marginal tax rate after all your deductions have been accounted for, i.e. standard deduction or itemization deductions.
Okay.
You can go to the next slide.
Okay, can we stop for one moment? Is there a way to put that in presentation mode?
If I do, it freezes. So if someone
Freezes,
wants to,
okay.
yes.
Okay, thank you. You
But
go
I
ahead.
can.
So one of the key changes in the next slide is the child tax credit. So for anyone having kids under the age of 5, there's an additional bump for 2021 that our current administration put into place that allows you to get up to an additional $600 per kid up to the age of 5 or under. And other than that, then if the kid's between 6 or 17 years old, there's a flat $3,000 fee for a child tax credit. The child tax credit for this year only is fully deductible, okay? Now, if you're one of these high taxpayers and high income, you do begin to phase out over a certain threshold of adjusted gross income. So you'll lose about $50 per every $1,000 over the threshold that you have there, but you'll still be able to keep the majority of the deduction long as you're under $400,000 of adjusted gross income, okay? So we move over into the next slide.
Yeah.
So here we are, Schedule A. Okay, this is very, very important. Right, this is a very, very important thing here. Okay, like in the slide 2, when I talked about the standard deduction, in order to use the itemization, you have to use majority of these items in here. And some of these items, like mortgage interest deduction and state and local taxes, have certain limitations to them. So, for instance, your state and local taxes, you guys probably heard of this the past few years from the prior administration, also known as SALT taxes, where you're limited to $10,000 of eligible deduction that goes into this calculation. Okay? So, we have property taxes and all this other stuff, and state income taxes from our paychecks, and a lot of, individuals are high net worth or high income producing, meaning greater than 6 figures, married, filing joint. Those numbers can be very, very astronomical in terms of itemizations that we're missing out on, potentially tens and $20,000. So, that's the prior administration put that in place. Next is the mortgage interest deduction. A lot of our mortgage interest is not 100% deductible. It's capped at $750,000 of loan balance that you have. So this is the one you got to take note for. You guys that have those mansions out there that are north of $800,000, you're not going to be able to deduct all that interest. And this is one for the key to consideration is that the IRS is cracking down heavily on this. This is one of these items that we call low-hanging fruit that the service is going after, and they're winning because a lot of you've received your forms this year, Form 1098, and it has your remaining balance of your principal mortgage on there, taxes, any mortgage insurance, and all that stuff. So the government has this number already in their file, and they're picking to see who has a balance greater than $750,000. Let's make sure that they did their calculation and they're not taking all of the mortgage interest deduction on the books. So I've seen a lot of it this year. They're going after it heavily. But this is one of those second items that go into the calculation of maximizing our Schedule A / itemization. Another thing is gifts to charities, churches, i.e., if you gave a check, that's your receipt, but make sure you have all your receipts as well. And also for any, charitable donations to Goodwill and Vets or whatever you have out there. And the last thing that factors into this calculation is other itemized deductions. Now, I specifically put this in there because I have a few clients that think that gambling winnings, you guys go down to West Virginia and you hit the slots and you hit it big. And, well, I got losses to go against that as well, but they don't go against that. You have to put them here and they get lumped in and bunched in with all the other expenditures to come up with your total amount of itemizations that you're able to deduct on your tax return against your income. Okay, go to the next slide.
Kevin, before you go to the next slide, I was going to suggest that I can share my screen and put it in presenter mode. So
Yep.
Joy, you want to do that? Okay.
Yep.
Okay.
So I'll stop sharing.
Okay.
And
All right. Just
switch
give me
over.
two.
And
Give me
we're
1 second.
moving into slide 6 when you do get it open.
Okay. So let me put on slide 6 and then put it in presenter mode. Okay. That good?
Yes.
Okay. So we're all, so you can go ahead now, Kevin.
Okay. Slide 6. Oh, here we go. Key considerations. There's a couple new items that are on the tax return. One thing is cryptocurrency. Some of you guys may have it, some of you guys don't. Cryptocurrency, Bitcoin, Ethereum, Litecoin. There's a box that has to be checked on the tax return. We say this, please check that box whether or not you participate. And that means if you bought only, please check the box you bought some crypto, so that way the government knows that, and so that way they can track it. So then the second consideration I have out there for you guys is retirement. Now, Ms. Tevlin mentioned to me you guys just recently had an estate webinar as well, estate planning. And this will go in concert with your estate planning as well. I'm seeing a lot of clients that don't take advantage of elderly law planning and stuff like that. So when you get ready to retire as well, you're planning for your estate, meaning afterlife and what you want to do with your assets. But while you're still here, how do you want to live? How do you want these assets to be utilized? It's key. It's crucial. It's more so than what you leave, to your loved ones, I would say, for the quality of life you guys would like to have.
We'll call you back.
Then the next, hello?
We'll call you back on a webinar.
Can you hear me? Hello?
Yes, I think someone was took themselves off mute. So Deborah, can you make sure everybody's on mute, please? Thank you. You could go ahead, Kevin.
Okay, and the next line item I think is very important until that time we get ready to retire and rely on what little Social Security that's going to be left for us. Just that, remember, it's taxable if you have other retirement income out there. Example, if you're a retired school teacher, if you're retired from Microsoft and you're receiving a pension or whatever from your 401k distributions and you're receiving your Social Security, well, more than likely your pension is going to be more than what you'll get from the Social Security. So because of that, you're most likely going to be over the threshold, which is going to require your Social Security income to be taxed a little bit more and up to as much as 85% of the dollar amount that you receive can be taxable. Clients from time to time, I suggest, hey, have, the Social Security withhold a little bit of tax, from your benefits that you're receiving. I know once we get on a fixed income, it's going to be hard to make those changes down the road. So as part of our retirement planning and what we're going to get from Social Security, we need to take this in consideration as well. Okay, next slide. This is another one that I think a lot of us don't really take it, take for granted. I apologize. Excuse me. That's something. It's the home sale exclusion. So when we sell our principal residence, when the home that we live in, we have what is called a tax-free gain up to $500,000 if you're married and up to $250,000 if you're single. What I've been seeing a lot lately is that people are not reporting this properly on their tax return. And by not reporting it properly on your tax return, you trigger an audit. And then when you trigger an audit, it brings more and more stuff down on you unnecessarily if you just report that properly. Even though the gain that you receive may not be taxable, you still have to go through the motions of reporting the transaction on your tax return. The government wants us to be transparent as much as possible. And the key takeaway is that you can't, do it for more than 2 years at a time. You can't do it back to back. You can't claim the credit. You can only claim the credit if you lived in your primary residence 2 out of past 5 years. And for single persons, it's $250,000. And for a married filing joint, it's $500,000. So, next slide. So in continuation with this home sale deduction calculation, I came up with this, which is basically how do you calculate what the value is of your home and what you're selling your home for and what the gain is that you need to recognize. We get lost in translation with this all the time. We think that we have a house that we're going to sell for $500,000 that we paid, $100,000 for, and it's going to be all gravy from there, and it's not. Or we've refinanced the property so many times to where we owe $300,000 on it, and that the sales price minus the $300,000 that we owe is what the gain is that we have to pay taxes on, and that's not correct. Here we are. What we got to do is take the sales price of the property that we're selling. We can add in our closing costs. We can add in any expenses we needed to get the house up for ready for sale, prepping, painting, all that stuff. Then we're going to subtract what is called the basis of the property. The basis of the property is what you really bought the property for back in 1985. What improvements that you've made back in 2000. And then any closing costs, if you can remember, if you still have the paperwork from the time you did that transaction as well. So that comes up to what is called the basis of the property. So you take the sales price minus the basis of the property, then you have what is called a gain or a loss, okay? If it's positive, it's a gain. Then you've applied the $250,000 if you're single, or a $500,000 exclusion if you're married, and the difference between the two, if the gain is $250 and you're single, well, you pay nothing. If the gain is $300 and you're single, you got $50,000. What is you have to pay capital gains tax on? And if it's a loss, well, guess what? You don't do anything with it, but you still have to report it. There's no deduction allowed for losses of a primary residence, okay? Next slide, please. The last one, everyone's been working remotely from home. And unfortunately, if you receive a W-2 from your employer, all those utility bills that have crept up, all the other expenses that you're utilizing by being at home all day, we don't have any eligible deduction for that. Okay, there's nothing that we can do for that. The administration put that in place and took that away back under the 2017, tax cuts. So we complain of prior administration for that. But if you're a Schedule C independent contractor or you're a single member LLC running your own businesses, then you're eligible for those type of transactions. You still can do the home deduction, and you still can itemize your expenditures and take a portion based upon the room that you're residing in to conduct your business and allocate the expenses among that to get to your home deduction. Ms. Joy? Hello?
Yes, thank you, Kevin. Kevin did a great job talking about the personal side of things. I'm going to kind of briefly touch on the personal side and then move into the business side. So most things. Oh, yes, ma'am.
Can we have we have a question in the chat?
Oh, sure.
Can we have I'm gonna read the question, and before we move on, I do apologize. But someone is asking, what would you consider if you are considering paying off your mortgage when you no longer have dependents or other debts, or keep as tax breaks.
So what will I consider if I have a mortgage and no other dependents, and would I consider paying off the tax debt? Okay. It depends. Okay. What do I also have going on? What's the cost of my mortgage? Meaning, what's the dollar value? What's my interest rate, what I'm paying on my mortgage? So I give you an example. If I'm only paying, if I want to pay off the remaining $100,000 on my mortgage because I got a great bonus last year for my company, well, am my rate that I'm paying on the interest, it's about 2.5% or less than 3%. Well, I wouldn't do that. That's not a good use of cash, in my opinion, because if you would deploy those resources in other different type of mutual funds or index fund, you can get a better return than paying off a mortgage that may or may not, allow you to itemize. But it's kind of like the sources and uses of money. What's going to be more beneficial to you? For me, it wouldn't be beneficial to pay off a under 3% mortgage, and I could use that money deployed in the stock market, in an index or a mutual fund where I can garner a conservative 7.5, 3%. 7.5 to 8% return, thus giving me a spread of 5% that I could take home and really put in my pocket and really benefit for. Because if your mortgage is that cheap, I would, hesitate not to. I wouldn't, jump down that one. I'm finished.
Okay, thank you. We do have another question in the chat, and I'm not sure if we want to hold on.
I would say let's hold on to that till we finish it, because it
Yes.
we could possibly get answered with what I'm getting ready to talk about, and it might actually help.
Okay, thank you.
So I actually agree with everything Kevin said. It's not a good use of funds, and in the long run, you could use that money in so many other ways. So for taxes, because what the goal is when you're paying taxes, a lot of people think the goal is to get a refund. It really is not, because when you get a refund, what that says is there was money available to you during the year that you could have used for other things and that you could have saved or put into other resources that you allowed the government to use on your behalf. And so with that, I'm going to go into tax exemptions versus tax deduction. Tax exemptions are yourself and your family, your children, what you can use to exempt certain income from taxes. So each person, usually with a single person, I think Kevin had it up earlier, you get a $12,000 deduction just for being you. And then each person has a dollar amount, whether it's a husband and wife, whether it's children, that's all attached to just you being you, and that reduces your taxable income. A tax deduction, on the other hand, is something that you've spent money on. So we went to Staples and bought some office supplies, and that reduces the amount of taxable income you have for the government. So there's a big difference. A tax exemption is usually something you get automatically for yourself and the members of your family that are in your household that you can claim, versus a tax deduction, which is something that you had to actually spend money on to actually be able to deduct it against the income that you have. Next slide, please. So talking about tax deductions, these are common ones. When you are self-employed, differently from when you work for a job, self-employed people have to pay for their own benefits. And so as a result, on your tax return, you can actually deduct up to 100% of the cost of your health insurance payments, of your HSAs, or any other health-related expenses. So those are things that can be deducted for you when you are a business owner. You also, Kevin mentioned it earlier, you no longer as an employee can take a home office deduction, but when you have a business, you're able to apportion part of your utilities, your lawn service, your alarm, all of those things can be, you can kind of trace them and figure out what percentage can be allocated to your home office deduction, and then reduce your taxable income to the IRS. Next slide, please. Also, you can do a retirement plan. That's self-employed people. You don't get the 401k like you do at work. You can actually figure out what we do for most of our clients now is it's one of the few deductions that you can actually do after the year closes. So we're in 2022. As long as the business owner puts the money into a IRA or a SEP 401k before they file their taxes, we can still make that deduction, which can reduce the 2021 tax bill. You can also deduct up to $100,000 worth of equipment, supplies, copiers, phones, expenses related to your business in that first year expense deduction. Next slide, please. And actually, I think we skipped the slide. That's okay. I'll talk about it. So what is an LLC versus an S Corp versus a C Corp? So whenever you start, next slide, please. Whenever you start a business, most people think, oh, I've talked to my friend, my cousin, my family member, and they said I should start an LLC. The reason people tell you to start an LLC because it protects your personal assets, which is the most important thing. If you have a LLC and you go out and your company, you're driving your car, which is owned by your LLC, and you hit someone, that person can't sue you and take your home. Or let's say you go out and someone says you didn't do a good job with whatever your LLC does. You sold them a faulty product. They can't take your personal property when you own an LLC. So that's one of the main reasons why people want to start an LLC. It is the easiest form of business besides a sole proprietorship. There's very little paperwork. There's no shareholders. The only issue is you can't reinvest the project profits, and there's certain things that you are not deductible as an LLC because you are considered a pass-through entity. So then what happens is people start to make a little bit of money and someone tells them, oh, you should be an S Corp. An S Corp is literally just a tax status. Your business was started as an LLC. It remains an LLC for the lifetime. You're just making a tax status to the IRS and to the state. In this case, most of us live in Maryland. You're saying to the state of Maryland and to the IRS, I want to be an S Corp. What does that mean? That means it gives you a different tax status. Your taxes still pass through to your personal return, but now you have to be an employee of the company. There are certain things that happen when you become an S Corp. So the S Corp paperwork can be a bit more expensive. So we do not always recommend that you become an S Corp until you have at least about $50,000 in profit, not sales, not revenue, but profit, because that's when it starts to become worthwhile for you. And then lastly, there is a third entity called a C Corp. Most people or most companies that are C Corps tend to be someone that wants to be large. So when you think of a C Corp, you think of Johnson & Johnson or Lockheed Martin. They're C corporations. C corporations, again, protect the personal assets, but they have a drawback too, because not only do they tax, it is treated as a separate entity from you. So you pay tax as a C Corp, then you pay tax on any money received from the C Corp as an individual. So that's considered double taxation. So you definitely don't want to be a C Corp unless you have probably about $500,000 in profit. The C Corp is not something we recommend until you know that your bottom line number is going to be worth it. Next slide, please. So again, which is better? It all depends on what your vision for your business is and where you are. You can start off as a LLC, become an S Corp, and then move to a C Corp. That is definitely possible to progress the business and have that happen as your business grows. But we recommend, if you're just starting out and you're unsure of what to do, it's best to start an LLC, because then that's the easiest one it's the lowest maintenance one, and it's easy to get in and it's easy to get out if you decide to change your mind, because we've had people who become an LLC and immediately elect S Corp status, and then they realize, oh no, I have to pay myself payroll, I have to do all of this stuff. And they didn't realize it cost them so much more, and they weren't prepared for it. Because when you start a business, usually you're bootstrapping it or you've borrowed money. And that's not everybody's situation, but most people. And so what happens is, if I borrowed money, or this is money that I already have over here, I don't want to pay myself taxes and pay taxes again on money that was already after tax dollars that I saved from years of working on a job. So then I'm not putting myself or my business in the best situation. So we do recommend that you kind of talk to a tax professional before you just start something, and you just make these decisions, because it has repercussions, and then it's harder for us to go back and clean things up for you. It's not impossible, but you do put yourself in sometimes awkward situations. Next slide, please. So again, a single member LLC for tax purposes is taxed as a sole proprietorship. So what that means is when you have a profit, you pay 15.3% of self-employment tax. What's self-employment tax? Well, when you have a job, if you ever look at your W-2 or you ever look at your paycheck, you're paying Social Security and Medicare, also known as FICA, and your job is paying the other half. When you own the business as an LLC, you are employee and job. And so you pay 100% of the taxes. So initially, when things are simple and you have low profits, this is the LLC single member is the easiest form to work with. As you grow, again, now when we hit that $50,000 in profit number, we don't necessarily want to pay 15% taxes. That's when we start to think, it may be time to become an S Corp, because now we can put ourselves on salary and provide ourselves with a reasonable compensation and decide how much we want to pay ourselves every payroll, and not cost ourselves money. And 100% of that is a deduction to the business. Next slide, please. Oh, before we leave this slide, people who have, as a sole proprietor in an LLC, you can take distributions, but beware. All distributions are taxable when you go to do your taxes. They are not a tax deduction, because this was money that you took out of the business. So you will wind up paying taxes on that at the end of the year. As you grow, you want to become an S Corp, because there are creative ways, because now as an employee, you can create certain benefits for yourself, such as over the next 5 years, you're able to, if you have student loans, your employee, if you're the only employee of the company, you can pay yourself $5,250 tax-free that you couldn't do as a single member LLC, because now you're an employee of the company. So you can set up your benefits to work for you. Oh, you can give yourself a car allowance. There are just, different strategies that you start to employ to reduce your tax burden. Next slide, please. And that is what I have for you. I know there's some questions in the chat, so I don't know if someone wants to unmute and read them, or Ms. Tevelin, if that is you, we can start to answer whatever questions you have, because I also have our tax manager, Micah Bird, on the line as well. So I think she was answering some questions in the chat as well.
Yeah, it seemed like Micah, and thank you, Micah, has answered most of the questions in the chat, but we could open it up to anyone that may have questions. You could put it in the chat, or you could feel free to raise your hand. And we do have a question in chat that says, which is better, a tax credit or a tax deduction? How do you suggest we stay up to date with tax laws and changes?
Whoa, that's a loaded question. I think because everything, I hate to be the politician, but it does depend. But I would say most of the time, having been in the business for about 20 years, I would say a tax deduction usually is better, because the tax credit is going to fade. A tax deduction kind of lives forever. So if you can deduct office supplies from now until the end of forever, but like the child tax credit, it came, it went. People don't realize that it has to be reconciled on their tax return. And if you got overpaid, if they based it on a prior year, if your child aged out of the program, you might, when you get your taxes done, it's possible that you may owe money from that tax credit. So credits can be very, very fickle. And so that's why tax deductions to me tend to be better long-term. And staying abreast, I say that I guess attending webinars like this is always helpful. And the IRS actually puts out a changes newsletter every year that can be followed so that you can kind of keep up. But I will tell you, over the last 24 months, they've put out so many different things that even we are having a hard time keeping up with everything because they're making changes constantly with each iteration of the CARES Act. Every time a bill comes out, there's a change in our environment, and that we have to kind of go back and figure out what's going on.
There's another one that says, can you address what the amount is you would get in inheritance without paying taxes or putting it in capital gains? Secondly, what is a K1?
Okay, so the inheritance tax, I believe, and Kevin, correct me if I'm wrong, I believe it is $5 million for 2021. It's up there, that usually as long as you have not inherited property and things. The issue becomes this: if you inherited property and you sell it in a year, either you are going to have to, that excludes property. If your, God forbid, your mother passes, she leaves you a home, and then you sell it, if there is, like what Kevin talked about, let's say you lived in DC and when your mother passed, the property was worth $1 million, but when you sold it, it's now $2 million. There's a gain there that taxes have to be paid on. So there's $1 million in a gain that taxes have to be paid on. And you can either pay it personally or have the estate pay it if there are funds available. But taxes are owed when there's a gain between the date of death and the date of sale. And then a K1 is a form that is generated from any corporate tax form. A K1 tells you as the individual how much of this profit or loss you can take on your personal return.
Okay.
Correct. Can you guys hear me?
Yes.
Okay, yes, I would agree. As far as when you inherit something, be careful. Also, there's timing rules there in terms of be careful what the will says, and then be careful when you get also what is called a stepped up basis. So if the property is $1 million, you can get what is called a stepped up basis. But if the individual holds the property for a little bit longer, then, you know, capital gains could be significant, like Ms. Joy said as well. So it depends on, you do get a little basis bump once you receive the property from inheritance from a loved one. So, you know, it's timing. I would say, you know, consult your local, you know, tax preparer or accountant, you know, for the rules regarding stepped up basis. And then depending how long you want to hold on to the property or not will determine the gain as well. Okay.
Okay, thank you. We have another question that says, are you saying a sole proprietor, if I pay, are you saying as a sole proprietor, if I pay myself 25% of income received, I have to pay taxes on the income received and the 25% I pay myself?
Not quite. What I'm saying is, if you, let's say you received income of $100,000 and you paid yourself $25,000, that $25,000 is not a deduction. You're going to pay taxes on the whole $100,000 amount if you have no other items to deduct, or no other expenses to deduct. That whole $100,000 is taxable because when you took the money and put it in your personal bank account, no taxes were ever paid. So I hope that helps.
Okay, and if it doesn't, if the person wants to take themselves off mute for clarification, and she says, yes, thank you.
Okay.
Another question is, suppose you are co-owner of a nonprofit and you work for the nonprofit and get a W-2. How is this taken into personal tax return?
So nonprofits actually can't be owned. You can be one of the directors of the nonprofit, you can be a founder of a nonprofit, and you can be a board member, but you can't actually own a nonprofit. The nonprofit is a separate entity from you, so it is tax exempt, but it can't be seen as you, not to say that you're doing anything incorrectly, but it can't be seen as just it's not a business. And I think sometimes people don't realize it. It's a business, but it's not a business where you can actually make a profit that can be split amongst the board members and things like that. That's a regular business. So so a nonprofit's income and expenses stay within the nonprofit's tax return. The W-2 you receive is the only thing that you wind up reporting on your personal tax return.
Okay, thank you. Is it true a nonprofit by IRS
Ah.
classification or by the registered state in which it operates?
So she's asking, did you register as a nonprofit? So people, you can register a nonprofit in the state without actually receiving the nonprofit classification from the IRS, which is the final kind of judge and jury on nonprofit status. So she's asking, has the whole process been completed to allow it to be, I guess, seen from IRS purposes as a nonprofit?
Yeah, this is truly a nonprofit.
Okay.
Okay.
And so then with the nonprofit, the only other thing is the nonprofit does have to file taxes, whether it made, $0 or $1 million, you do have to file a return every year. And if by chance you don't file 3 years in a row, they will revoke your nonprofit status.
Okay, but then you have to itemize of where all the monies are coming from the different organizations or.
If you have $50,000 or more, if you have less than $50,000, they have what's called a 990N. You just go in and
Right.
you say we had less than 950, and there's nothing to itemize. It's really just a one-page form to keep the nonprofit status.
Okay, all right, thanks.
Okay, I don't see any more questions in the chat. And I'm looking to see if there are any hand raised. Does anyone else have any questions? Feel free to ask, questions. This is your time to ask any questions or get clarification.
While we're waiting for everyone to, if there are any additional questions, please remember to fill out the evaluation survey. Tevlin, I know, has shared it, and she shared it again. So we really would love for you to fill that information out. And I'm sure that Joy and Kevin would love to answer any more questions that you all might have.
Yeah, I have a question. Going back to your personal taxes, if you own a house, Kevin, are you saying that when you do your tax return, the capital gains is a part of it because of the ownership of your home? Is that what you're saying?
No, I'm saying it's when you dispose of the home, when you sell your primary residence. Okay, when you sell that home to go buy another home, is when you would disclose the capital gain or and make that exclusion, whether it's 250 or 500. It's only when you sell the property.
Right.
It's only when you sell.
Okay, thanks.
You're welcome.
And we do have another question in the chat. It says, is there a special form to report sale of home?
Yes, there's a form, and I'm drawing a blank. I know it goes on Schedule D as well.
8949. I believe it's the 8949 form.
I have a question. I sent this in before the webinar started, so I don't know, but I was late, so I don't know if it was answered already. But I have, I invested in a company. I forgot what the platform it was that I used, but I have cryptocurrency also, and doing what's the other thing? Stocks and stuff, the acorns. So I got money invested, spread around, and so I was wondering what that looks like when I go to file my taxes. One as a business, I invested in a company, and then the other personal. Is there I know that Kevin said that there's a cryptocurrency box you check off, but is there anything else that I would have to be aware of in preparing my taxes regarding that?
Okay. Yeah. So what you, in your Acorns account, there's a tax statement you should receive, probably called 1099 Div, 1099 INT, or 1099B, sales and proceeds from broker and exchanges. So if you sold any stocks or anything like that, all those will be reported right there, gains and losses. Like you sold 3 shares of Apple for a gain of $27. All that will be reported there. And also, I've been seeing I've seen this on Robinhood. I haven't seen it on Acorns, but they are providing you with a cryptocurrency 1099 transactions. Okay, you bought Ethereum, you bought Litecoin. This is what you paid for. This is what you sold. You know, you sold some Ripple, and you now have to document those on what is called Schedule D, your gains and losses, capital gains. So, but you would take that those transactions on Form 1099-B and put those into the program. If you're, you know, doing using a TurboTax program, they'll walk you through it. Hey, did you sell any stocks or bonds or crypto? They'll probably walk you through that. Now, as far as the business that you invested in, it depends on what type of entity the company is. If it's an LLC or if it's an S corp, you should receive what is called a Form K-1 to give you your applicable share of income from that particular entity. If it was a Schedule C, then you wouldn't get anything from that particular entity unless it gave a dividend or something like that. And then that form, they should send you what is called a Form 1099 Div, and saying, hey, we gave this young lady, $300 in dividends from ABC Corporation, and then you will report that on your Schedule B dividends and interest form.
Okay. Thank you.
Does that help?
Yes. Thank you.
And Joy, you want to add to that, Miss Joy?
No, I think you were spot on with what you said.
I have one more question about the nonprofit. If you invest, if you donate money to the nonprofit that you're a co-owner of, can you how up to what level can you deduct on your taxes as a charitable donation?
It's going to depend on what's called your adjusted gross income. So you should get the letter for the total amount that you donated, because you'll be able to roll it. If you can't deduct it all now, you'll be able to roll it over to future years. So that you should always get the donation letter, no matter how much you've given to the nonprofit.
Right, but you can't deduct it on your taxes.
You might be able to. It depends on how much income you have.
Oh, okay. Based on that. Okay, thanks.
And then to add, that will also be lumped into that Schedule A transaction. So if you do Schedule A, like mortgage interest and state taxes and other charitable, it will be lumped into that calculation. But what I would say is another, key for consideration when you say you own the non-for-profit or it's yours, you founded it. When you're dealing with related party transactions, be very clean. Be very clean, like separate the transactions best as possible, get your letters best as possible, have your checking account, whatever you want to write the check to the organization and nonprofit, be very clean as possible and be very specific, because the last thing you want to do, the government coming back in and say, well, no, this doesn't qualify for that. You don't have the proper paperwork, so that your deduction, we're going to disqualify. They don't really like to unravel, but they will unravel if it's to their benefit. So when it's related party, meaning you guys own the nonprofit, you founded it, just be very clean in your transactions and get your paperwork signed. Even if you loan money, make sure you get, loan agreements out there and all that stuff. Just be very, very tight with it and with your paperwork, okay?
Okay. In other words, on the check, that when you donate by check, in the memo section, make sure that I put down donation or loan, like that sort of thing, along with getting a letter from the nonprofit that how this money was given. Is that what you're saying?
Right. And then, yes, ma'am. And keep a copy of that. Say, hey, I donated to KLM nonprofit, and here's my check. I got a copy of the check, because nowadays banks don't give checks back. So keep a copy of it. Keep it with your records. Remember, you should keep, all your tax records for at least 7 to 10 years,
Right.
So try to keep those records and keep them clean. So that's the way, especially when it's directly tied to you. You want to be as clean and neat as possible to show that there's no improprieties going on. So we're not going to bust this up as some type of hybrid or anything, but just be very clean You know,
Okay.
I work with a lot of small nonprofits. They say, "Oh, Mike, you know, no, you can't do it that way. You got to do by the book if you want to
Okay.
keep your nonprofit status."
Right. Okay. Thanks.
We do have a question
You're
from
welcome.
Kat Ward. Kat, you
think-
can ask your question.
Thank you. I would like to go back to the inheritance tax. I just want to get clarity. Did you say that the money that you receive from a relative who has passed is going to be 100% taxed, the full amount, or is there like a cap on that for state of Virginia?
Well, let me start. It depends on what the money is, okay? When you say I got some money, how is that? Do I get access to a 401k account? Do I get access to a retirement account where I'm a beneficiary? Do I get some insurance proceeds? Or did grandma leave me a house? You know, it's different methods. You know, did she just give me all the cash in her checking account? Well, it's totally different things right there. So it depends on the type of money you're receiving from the different vehicle that you're receiving it from will determine how you play it out. Because some things you can roll over and some things you can hold on to and some things may be free, you know, like the insurance proceeds. So, Ms. Joy?
Okay, so the insurance proceeds are free and the money you received from their bank account, that's going to be charged as tax? Because that money's already taxed. You know, it came from their
Well, the
pension.
money's already, it came from their pension. So the question is, did they receive a lump sum like pension payout? So when they're receiving a pension over a period of time, monthly, and if there's a beneficiary payout of what's remaining, that will come to you in a form of what is called a death benefit, and you'll receive a form 1099-R as well. And so you would have to report those on your taxes as well.
Okay, so speaking of death tax, do you happen to know how much that is for the state of Virginia? Or
Not off the top.
Okay. Could you share anything on that death tax? If not, that's okay. I
Ms.
just
Drew?
get an idea.
Yeah. Go ahead, Joy.
Joy had to
Hello?
leave. She had to step away. She had a call.
Oh, okay. Well,
Okay.
thank you. Mhm. That's all. Thank you.
Okay. And Ms. Ward, feel free to
If
reach
you-
out to either Kevin or Joy, you know, offline for more details, because you may want to get a little bit more details, you know, in person or over the phone. So, you know, please feel free, you know, to reach out to them.
Yes. Okay. Well,
Correct.
thank you.
Thank you. I was going to suggest that, you know, my email is on the front of the on the presentation. So feel free to reach out to me, and I'll do the research for you and get you an answer that you're looking for. Okay.
Okay. Thank you.
And Deborah, can you
You're
share
welcome.
the presentation? I'm sorry. Can you share I think it's on the last slide, so everybody could take a look just in case they do want to reach out to them, and Ms. Ward could have that information. If you could share, I think it's on the last slide, their information, contact information. I think on the last, that's Kevin's information. And I think on the last slide, it
So
may,
she asked for Kevin's information. His information's on the first slide. Joy's information's on the last slide.
okay, thank you. Thank you. Do we have any other questions? Just looking to see if we have any other hand raised in the chat. Okay, and just the, and can you just share Joyce as well, just in case people, thank you. Okay, we do have a couple more poll questions that we would like to ask just to get, just to know how your knowledge is, after receive this information. So we would just like to ask a couple more poll questions. So Deborah, if you could bring up those poll questions. So after you received all of this information, now we'd like to know what your knowledge is based off of the information that was received. And if you can mute everyone, Deborah, please. Thank you.
Stop the poll.
Okay, I think we
5
can
more
end the
seconds.
5 more seconds. Okay.
Okay, I'll end now. Can you see the result?
I think we can end the poll now.
I ended it and I'm sharing it. You can't see that?
Okay, yes. I just wanted to make sure it was ended. Thank you.
Mhm.
Okay. So what is your current knowledge of the individual taxes? And this is after the information was shared. And we have 60% that says moderate, 36% that says some. And then we have, what is your current knowledge of business taxes? After the information was shared, and we have 76% that said some, 12% that said moderate, and 8% that said none. So it did look like it went up some. I can't remember the numbers from the very first one, but from what I can remember, I think the knowledge area has gone up, which is great. So we would like to thank everyone for coming out. Please remember to take the survey. The survey's in the chat. So we would like to have your feedback, and we will continue to have a few more Financial Fortitude Fridays. I think the next one coming up is in April, which we will have on Medicare, Medicaid. And we'll probably have another one around June, which will be on purchasing, a home. So look for that information to come out. We will share the, I think, somebody's hand is raised. I do apologize. Deborah Thomas, do you have a question? I see your hand raised.
Oh, that's me. I was raising it just to let you know that it did increase from the initial pre-knowledge was 56%, and that changed to 60% after.
Okay. Okay, thank you. Thank you for sharing that information. And we will share the recording. This webinar has been recorded, so we will share that recording out to everyone, along with a copy of the presentation. So you will receive an email from us on that. And we just like to thank everyone for attending. And stay safe, and everyone have a good night. Thank you.